Well, everyone's trotting out the phrase significant downside risks at the moment. Yesterday it was the IMF, last night it was the US Federal Reserve Board, announcing its so-called Operation Twist, which basically means buying another $400 billion worth of long-term bonds from banks to give them a bit of spending money. But $2,300 billion worth of debt purchases over 2 years from the banks have made no difference, so no one thinks this will either. Markets instead focused on what the Fed said, which was, you guessed it, significant downside risks. Investors heard that and lopped 3% off stocks, and there were similar falls in Asia today. Now, as I mentioned yesterday, the share market is down 10%, but the credit market has fallen much more, and it's still going. The chart shows the Credit Default Swap Index, which is a kind of all ordinaries index of traded debt securities, and it's in a full-scale rout. The actual all ordinaries fell 2.5% today, and the big miners were absolutely crunched. They weren't helped by some soft data out of China as well, but Rio Tinto fell 6.5%, and it's now on a price-earnings ratio of less than 9 times, which is incredibly low. Likewise, BHP. If investors don't buy at these valuations tomorrow, then they really do think the world is heading for a major recession. The local market has now fallen below the previous 2011 low, which it hit on August the 8th. The Australian dollar is sitting at parity tonight, wavering just above and just below that level. That's a fall of 2.5 cents in 24 hours, which is just stupid. And by the way, the Reserve Bank's annual report came out today. The governor got a modest pay rise, but the bank lost an immodest $4.9 billion on foreign exchange transactions. And that's finance.